Okay, traders, let's step into our gold analysis. But before we start, I want to make sure you maybe get your email gold analysis and Euro USD analysis we provided to our clients last week, and it's a good addition to understand what the market is doing right now. We are at the very crucial points, and of course, you want to have something written. Don't only look at YouTube videos, you will forget. Don't look at YouTube videos only. You have to have something written, and maybe if you want, you just can write us at solidprofittrading at gmail.com, and we will provide you with our gold and Euro USD analysis of last week. But let's start with our gold analysis on this YouTube video channel. And maybe an important thing for all the new traders and beginners. Lots of traders lose very much money. And they lose all of their money because they don't look at the highest probability trades. What does that mean? You want to make sure that your trades are always on a risk reward ratio more than 1 to 2, 1 to 3. You have to look at your high risk reward ratio. And how can you do that? Well, the probability is higher if you look at the bigger time frames. Okay, we are here right now looking at the daily chart, and I suppose if you're a beginner, if you're new to trading, that you are still working on a job, whatever. You are still working and you don't have time to look at your mobile. You don't have time to look in your computer to check the quotes. Okay? So you have to fit it in your daily business. You have to fit it with your daily times. So make sure that you have the highest probability traits, and this is only possible if you look at the higher time frames. So don't think you are a professional trader. Yes, as a professional trader, you are in front of the monitors the whole day. You have time. You have time to take 10, 15, 20 pips out of the market. But if you are not a professional trader, you have to look at more than 30 pips. You have to look at more than 50 pips. Okay? So even if you do your chart analysis, your fundamental analysis, look at where the big moves are. And this is a good intro to start with gold. So where are the big moves? This is a big move. These are the big moves, and they happen only on a daily time basis. And of course, it's not the point of you taking exactly the perfect time, the perfect entry. Of course, timing is everything, you know that, but don't think you will be able to get the perfect entry. No professional trader thinks that. Okay, that's why you have to leave some space with your stop loss. When you enter a trade, you have to leave some stop loss. Okay, this means 20, 30 pips. And of course, these 20, 30 pips represent your risk. Your risk, one trade, maybe 1% of your deposit. Okay, so make sure that this distance to your stop loss is maximum 1% of your deposit. And then again, leave space, leave room for the trade to develop, to evolve. Okay? So always begin with the bigger time frames that tell you where the big moves are coming from. Now we're looking at a dollar chart, and you see where how to define the trend. You're looking at the trend and you're clearly seeing that we still are in a downtrend. It's a bearish market. Look at the monthly. This is the monthly chart of our gold. Okay, this is gold on a monthly basis. What does that mean? We are still in a downtrend, and to get the highest probability trades, you will also look at getting a trade where it's going down. So now if you have this philosophy, as I'm telling you right now, you want your highest, biggest chances to get out of the market, you have to ask yourself, do I want to go short or do I want to go long? Now, let's look at the 4-hour chart. We saw the 1-hour chart, the daily chart, sorry. And even in the 4-hour chart, you're seeing that we are on a very clear downtrend. So I'm asking you, if you don't have time to take 10, 15, 20 pips out of the market, why do you go long? Why do you go long? Okay? So look at the downtrend and you want to go with the downtrend. Of course, now you're asking, but where should I go in? Where should I go maybe short in this case? Okay, Fibonacci you're seeing here, and you know, if you read something about Fibonacci, you know where the highest probability trades are. Look at the 0.38, look at the 0.50 retracement, and there's where you consider entering. Okay, where you consider entering. Consider entering means you look at that price level, and before you enter, you want your confirmation to happen. Okay, so let's get more practical. So you're seeing now live your gold chart, and the price is at 1230, this level. Where are you? If you're looking at the price chart and the volume zones, these are the volume zones where the price spent lots of time, where the big players had the possibility to exchange a lot. Okay, these are the high volume zones, and the price is likely always to get to remain in that area. Now, right now, you are in the middle of nowhere. You can tell me, okay, I want to go long. Okay, where would you go long right now? So look at your risk reward ratio if you go long now. We said we're in a downtrend, and if the level hits up here, the probability to go down is very high. So why would you go long right now if there is a high probability that the price will get to the 0.38 retracement and fall again? Why would you go long now? Okay, so you say, maybe I will let the price correct down here and go up then. Okay, but of course, then you have a very tight stop loss in this case. Okay, maybe you should set your stop loss here, and then you have a risk reward ratio. Okay, so better explaining with these rectangles. Okay, this is your profit. The green rectangle is your profit, and the red one is your loss. Okay, so we said if you would enter right now, and you know there is a high probability that your trade will stop long at this point, you have maybe a 1-to-1 ratio. Of course you could enter, but as we said, as a person that doesn't have lots of time, and you know how volatile the markets are. If you are 2 or 3 hours away from your computer, your stop loss will get hit, even if you were right. So look at your highest risk reward ratio. And as we said, now you assume, you say, okay, I let the price fall down to here and enter right here. So what does happen? Of course, you bigger your profits, and it would look like this. Okay, this would be possible. You see clearly that your risk reward ratio is bigger, 1 to 2 at least. Okay, so this would be possible on a daily basis. Again, we are looking at the 4-hour chart, and on a 4-hour chart you have plenty of times to check the price. Okay, of course you can put in limit order so you can get filled automatically, and this is another issue. But again, as a non-professional trader, you have to look at the high probability trades. This will get you the solid profits on a long run. Okay, so this could be a possible trade if you assume that the price will now fall down into this volume zone again, and then will bounce up again to a higher high, to our retracement of our downtrend. Of course, you could assume, and when the price is at this level, you can see what kind of reaction happens. If the price doesn't bounce back heavily, you can say, okay, I will take my first profit here. I will reduce the size of my position and let the position run. And maybe the second take profit is up here, okay, on the 0.5 retracement of the long downtrend. This is a possible trade on a daily basis. But again, if we look at the really big possibilities, is this a big possibility? Maybe. This is but even then, smaller than these big moves. Okay, we hit a crucial point at $1,200. This price level is very crucial, and the price went back, bounces back from this point of level point, and we have a confirmation on a weekly basis, because on a weekly basis the price stays up, and we can assume that this is a possible trade. But on a really long run, what you want to do as a non-professional trader is to get the highest probability trades. And then if you say we want to go short, we're looking on the weekly basis. If you want to go short, look at what happens with your risk reward ratio. So again, we take this and we say we want to go short. Of course, we have to switch it right now. We switch it and say, okay, I will wait. I will have patience till my price level comes up to a really high probability trade. And this is maybe the retracement of the 1.38 or the 1.5 level of the Fibonacci retracement. So we'll look at your risk reward ratio. What happens is like this, and then the big trend will continue. Okay, this is maybe possible, and the trend will go down. To which level? To which level? Let's look. Look at this. Look at this. Okay, it could come up, could come down to this level. So huge, huge risk reward. And this is the trades you're looking for if you are a beginner. Okay? So you wait for the price to come to the really high probability levels, and then you look at the price, what the price is doing there. Is there really coming, in this case of gold, is there really coming a sell-off? Is there really coming a sell-off? Will the sell-off be confirmed? Confirmed means do you really see great sell-offs on a daily basis, and then you could go short. Okay, is that clear? If not, just write us an email, write it on the comments below. We hope you could learn something right now. Just stay solid.